Okay, good afternoon, everybody. Let's go ahead and get started. Let me know if you guys can hear my audio and see my screen in the chat box. Just give me a little Y or yes there. Just let me know that it is indeed working. Hope everybody's having a fantastic afternoon so far. Happy Monday. Got to see a lot of you guys this morning in the live trading call. I think we're going to have a great week, so I'm looking forward to it. I've been looking forward to this webinar. We're going to talk about how to identify, trade, liquidity, and imbalance zones. We've talked a lot about liquidity, but we're going to spend a lot of time on imbalances tonight or this afternoon. And I'm excited because this is really a cool thing because I like to hunt, and hunting is it's just in my nature, I guess. And so this when you go out into the charts and look for trades, this is the kind of stuff you're looking for. When you want to read the charts and actually find out, okay, where is the market likely to reverse, or where are things going? That's where we talk about liquidity and imbalances. And so I'm really excited about this webinar. I've prepared a lot. I've put some charts aside that I think will be good examples, and I'm excited to get into it. So let's jump into it. As always, I need to remind you guys about the risks involved in this market. You can lose all or more than your initial investment if you're not careful. So please be aware of how many pips you're risking on each trade, in addition to how big your lot size is, and ultimately how that would affect your account if you were to lose money. So make sure that you're going through that process each and every time that you take a trade. All right, guys. So here's how I want to start. So we're going to talk, like I said, here's the topic of discussion. We're going to talk about trading liquidity. First, how to identify liquidity and imbalances, and then secondly, how to trade liquidity and imbalances. So in order to understand an imbalance, we have to understand liquidity, and in order to understand liquidity, we have to understand some basic fundamentals about like how the market moves. Okay, so the first thing I want to start off with, let me actually pull up a chart. I'm just going to pull up a random chart here to illustrate a few things. So when you look at just this is just an hourly chart on the pound Kiwi, pound New Zealand dollar. We have to identify uh, that the market does three different things at any given time. The market's either going up, it's either going down, or sideways. Okay. But those are the three different ways the market goes. Okay. So we call a big move up like this, that's an expansion, or a big move down like this, that's also an expansion, but one is to the upside and the other one is to the downside. A contraction is what we call a consolidation, or a market moving sideways. So a sideways moving market would be kind of like this right here, or even like this over here. Another sideways moving market would be something like down in here. Okay. Sideways moving market. So the market actually spends most of its time, and this is another really important key concept. The market spends most of its time doing nothing, and it likes to spend most of its time in contractionary phases, but that's not where the market really moves. The market really moves during expansion phases, but expansion phases don't happen very often. Or they happen all the time. They happen often. They're just not as frequent as contractions. Okay. So when do we see expansions, and when do we see contractions? Okay. So in the world of Forex, it really depends on the time frame you're trading on, because if you're trading on a much higher time frame, like an H4 or a daily time frame, the moves that you see are happening over many weeks at a time. And so the expansions can happen in just a few days. And then a lot of the times the market's not really doing anything. If you're trading on a smaller time frame, like a 5 minute or 15 or even a 1 minute time frame, it has to do with the session that you're in. Okay. So that's a really important key concept. If you're going to be a scalp trader, the expansions that you experience are really defined to the session or the news event that you're subsequently trading. Right. So if the New York market just opens up, there's probably going to be a lot of expansions pretty quickly. You're going to move if you're in a contraction phase, that currency pair or instrument is likely to move. If London opens up, that's another one, and you're in contraction, then you're probably going to break out of contraction and at some point go to expansion, right? So the markets, and then when they're done from expansion, they'll go into contraction. So that's another thing. Like right now, we're at the end of the trading day. I never take trades in the afternoon. I don't even really look at my trades in the afternoon. It'll drive you crazy because the markets are just in contraction, And if you look at your trades during rollover, you'll be always disappointed. It doesn't matter what trading strategy you have. By the way, rollover is between 5 p.m. Eastern and 6 p.m. Eastern every day. I live in Mountain Time Zone, so it's between 3 and 4. So if you ever look at your trades between 3 and 4 in anything like stocks, Forex, especially Forex, I feel like you're always going to be disappointed because it's the time of the day, right? That's like it's the 1 hour when the markets aren't open. London, New York closed, you know, at 5 p.m. Eastern, and then Sydney doesn't open till 6 p.m. Eastern. And so you got that 1 hour period where nothing's open, right? Okay, so we're always moving in contraction and expansion, and that's really important. So who creates the expansion? Because obviously, like if you see a move up like this, somebody created that move, right? Somebody did this, right? I didn't do that. I don't have enough money. None of us have enough money, even if you are well off. None of us have enough money to create moves like that in the market. You have to have many billions of dollars to create big moves, or at least in the hundreds of millions, at least, just to create a short-term move in the market. And uh, so expansions are created by institutions. Okay. We try to anticipate those expansions. So I don't try to create them. I just try to anticipate them. And that's what this webinar is for, is to how do we anticipate uh, liquidity zones and imbalances and so on. Okay. So like I said, this is an example. Um, here's an expansion right here. A bank had to create, or several banks had to create a move like this. Okay, so now that we've got that kind of covered, the next thing I wanted to mention is this. So during contractionary phases, that's where most of the buys and sells in the markets take place. Okay, so what do I mean by that? So scalpers, if you think of about people who trade on the smaller time frames, they get kind of caught up into the chart on the smaller time frame that they're on. And if you hear about, scalpers who lose their accounts or they blow up their accounts, it's usually because they're caught off guard by some expansionary phase and they're in the wrong direction of that expansion. Okay. And they didn't have, proper risk management and they blow up their account. That's how a lot of scalpers or real short-term traders lose their pants, right? Is through that kind of style of trading. So during those periods of time, like during contractions, is when most of the trading actually takes place. During expansion phases like this, I mean, how many of us are going to be at the market just in time? Like, for example, when you look at this big bullish move right here took place, how many of us are going to be, how many of us are actually going to be at the chart right when that happens, right? Not very likely. It's very difficult. And how much of us are going to, I mean, how many orders got placed during this expansion versus how many orders were taking place during this contraction right here. Okay, so if you think about it, this was just three candlesticks, that bullish move, that's all it took. And then between here, like if you were to measure this, you can use this measuring tool. If I were to measure between here and here, that's 45 bars or 45. We'll just say 45 bars of contraction, and then it only took 3 bars of expansion, right? So it's really kind of crazy when you think about when is the money made in the markets? It's such a short period of time, right? This is why I constantly preach every week about the importance of being prepared and having your orders set. Because if your orders aren't set, like you'll wake up and you'll be like, man, I knew the market was going to go that way, but I wasn't ready. I didn't have my trade ready to go. I just missed it completely. Right. And it's happened to me. It happens to me still, even though I know about this. Right. So, okay, cool. So, I just wanted to explain that concept. So, with that, that brings us to liquidity. We're going to get to imbalance in just a second. I want to make sure we cover liquidity first, and then we'll get to the imbalance side, okay, which is a little bit more of a technical side. But let's make sure we really cover liquidity because that's a little bit of an easier concept to understand and grasp. And then imbalance will come up next. So basically, what we have here is like whatever order took place in here, whatever the banks did, ultimately created this breakout of expansion. Whenever you have an expansion out of a contractionary phase, there's always somebody left behind. Okay. And not only is there somebody left behind, but there's a lot of things going on. Okay. So think about it. You have buyers and sellers who are willingly buying and selling in this phase of contraction, and then the expansion comes. So the buyers are really happy. So let's talk about the two different groups. So the buyers are thinking, wow, job well done. We're making our money. This is great. How are the sellers feeling? Job not well done. We're losing money, right? And the market's going against us actively, right? Um, you have a couple of options. You know, if you're a trader and your style is to get out quickly, you can stop out and move on to the next trade. But there's plenty of traders that don't trade like we do, where they just stop out of trades. Some traders will just perpetually hold on to bad trades, and they'll do anything they can to get their money back, right? As soon as the market gets to a price where it's an acceptable loss, they'll just take the loss, right? That's a really important piece of psychology, because if we can find where those people who are trapped are likely to get out of their positions, then that's where reversals likely take place. Why is that? Because if um basically if a seller gets out of a position, they subsequently bought. Okay. If a buyer gets out of a buy, they sold. Okay, that concept's easy to understand. Like if you own something and you want to get rid of it, then you have to sell, right? That's an easy thing. Like you buy a house, you want to get rid of it, you sell it. Easy. Buy a car, gonna get rid of it, sell, right? And the opposite's true if you're a seller first. Like if you sell the market and go short, in order to get out of your short, um, you have to buy. Now, on your trading platform, it may not say buy. Like when you go to close your position, you may not buy. You might not hit the buy button. They might make it easier for you by just hitting some kind of like X button, and that closes your position. But in reality, in the back end, you just created some kind of buy liquidity in the market. And that's really an important piece to know, because it tells us more about the characteristics of the market. Okay. So now, why is that important here? So liquidity in its general sense, like the way I view liquidity, this is not imbalance, by the way. We're going to get to imbalance in just a second. But liquidity is basically the previous contraction that created the subsequent expansion. Okay. So to me, this is a liquidity zone. This whole area is liquidity, in a very general sense, because whatever orders took place in there is ultimately what created the expansion. And it's also the same place where traders are trapped who were in the wrong direction. So if they could break you, because like if you're, think about it, if you're suffocating on a trade, if you're losing money and you just have to hang on and hang on and hang on and hang on, the moment you get that trade back to break even, you're closing that guy, right? And that's how the loser feels. Now, how does the winner feel if their winning trade goes back to break even? Well, what do a lot of winning traders do, like us, when we get to a profitable point on a trade? Well, we will often bring our stop losses to break even as well. So we're doing the same thing as the losers. The winners are doing the same thing. Like everybody has the same, they're looking at that same liquidity zone. Okay. So that's liquidity in a general sense. Okay. Some people will call this, like you might hear from other programs, they'll call it like a banker's candle. And those kind of work. I don't really like the idea of the banker candle. I don't like to limit a liquidity zone to a singular candle. But one way to look at it, if you go off of just like a candle, is they'll take the previous, like if this is a move up, which it is, um, they'll look at the previous big bear candle before the move up. So that this bearish candle right here, a lot of people refer to that as a banker's candle, because it's the last bearish candle before the big move to the upside, right? And that alone could be a liquidity zone if you were to just isolate that candle by itself and then draw this out sideways. That could be liquidity. Um, And let's see, did that area actually hold? Let's see if that area, no, it didn't quite hold. See, that's why I don't like to go off of just the candle itself. I don't think that's enough. I think you need to give the whole liquidity zone a fair shot. So that's why I don't use just bankers candles because I've the people I know that actually teach them don't consistently trade that way. So that's why I use the whole zone. Like, okay, this is the place where liquidity is likely to be. Okay. Over time, I've kind of learned not to just like the top of liquidity doesn't usually work as well. I've kind of found if you place your orders like midway through the liquidity zone or even through the bottom, I get better RR ratios that way. But that's just a general sense. It's not always the case either. But anyway, that's liquidity. Let's try to find another look, and then we're going to move on to imbalance here in just a second. But let's try to find. Oh, so how do you know like again, how can you find liquidity on your own? Okay, so liquidity, let's go find a big move in the market. Let's find a big like a big breakout of structure. Yeah, like this right here. Okay. So this is a market that was up here. It was kind of in a contractionary phase, like right through here, and there were some expansions throughout here, but it's mostly a contractionary phase relative to some of these other moves that we've seen. So this is kind of a sideways, and then what ultimately happened here is we broke structure. Okay, right there. So that's where we finally broke this support zone. This was support, as you can see. Definitely was support and support, and then it finally broke right here. So when this happens, there's a liquidity opportunity lurking. Okay, so you got to keep your eyes out for liquidity when you see a break of structure like this. So like if you could rewind and go back in time, this usually means that there's some kind of liquidity opportunity. So what you want to do is you want to go back and find like a spot that basically you want to follow the move backwards. So if this is the move that happened that ultimately broke structure, you're going to want to follow this back to the area that created the subsequent like break in the subsequent break in structure. So there's two areas that come to mind. I could definitely see this area kind of being a liquidity zone because whatever took place in here ultimately was the final decider and reason for this to pull back. There was also this area kind of up in here. That's also in general a liquidity zone. So all of these zones would be like general areas to sell. And it looks like the market actually did pull back up into this area and then ultimately pulled back um, a couple of times even, and then it came back up. Looks like the second one worked actually better. So there's that one I just showed you. And then you can see right here, there's this one right here. So this is kind of like where the market reversed in its contraction and ultimately slid off and just went down and down and down and down. So that would be a liquidity zone because that means what that means is that there were a bunch of people who sold right there and did really, really well. And there's people who bought up there who are not doing very well. So what happens is when the market regresses or returns back to that area that created that subsequent impulsive move, which we call an expansion, uh, that means that the sellers are breaking even and they're using that as an opportunity to get out at break even. And it also means that the buyers um, are who were losing money are getting out. They're closing their buys out. Okay, so they're using it as an opportunity to finally break even on their trade because they finally got that opportunity. They were losing for so long, they finally closed at break even. Okay. So that is an example of liquidity. Maybe we'll do one last example of liquidity and then we'll move on to imbalance because I want to make sure everybody gets this concept. Okay, so here's another good one right here. So um, yeah, this is actually a really, really good example. So right here, um, this actually had a lot of things going on with it. This had like a kind of like a trend going down, and then it ultimately broke structure right here. And not only that, but it had a nice little resistance area right through here. That was resistance. This was resistance. And so when the market came up to here, it broke structure as well. So you got two different breaks of structures on this pair. Okay, BOS, and then you've got another BOS right here. Okay. And okay, so you got two different break structures, and this is all basically one expansion. This is a whole move right here. Okay, this is a whole move in itself. Okay. And so the banks created this because it broke two different structures. Again, we don't have enough money to create these types of moves. So the banks moved this and they caused this break first here and then the second break here. And this is all one move. So what do you do? Like, how do you find liquidity? Well, you basically follow the break of structure move backwards until you find the base or the what we call contractionary phase. It's also known as consolidation phase that created the expansion. So this is the expansion right here. This is where the market really took off. This is where people were having a marketplace. They were buyers, there were sellers. The market spent most of its time down in here, and then it ultimately broke out. Okay. So whatever happened down in here is what created liquidity, right? Because this is the liquidity that was necessary. It was the launch pad for the rocket that broke all those structures to the upside. So when you follow it backwards, this is the the base, the home base that created it. So you want to just find the contractionary phase where the market was kind of going sideways that created the expansion, and that is liquidity. That's the definition of it. Okay. Now, if I pull this forward, look what happened when the market regressed back to liquidity. It came down and then it took off from liquidity, right? Just went woo, way up. So that's why I was saying this is a really good example of a liquidity zone. Okay. Um, Basically what's happening here. So you have buyers that are doing really, really well. They're happy with their position. Okay. You have sellers when this thing took out, when this thing went off, you had sellers who sold down here. They're like, holy shoot, I took a bad trade. Right? Have you ever done that before? Oh, yeah, I've been there. They're like, oh boy, I thought this was going to dump. I thought this was going to keep going down. I thought that trend line was going to, this is how the seller thinks. They're like, oh, I thought this was going to keep going down. It did not. And it just goes right up. It just keeps going up. So if you're a seller and you have an opportunity, if you're gifted an opportunity to get out of your sell for break even down at this old liquidity zone where you originally sold at, oh yeah, get out because that was a terrible decision, right? So you get out and then what happens if sellers close their position? What's the opposite of a sell? It's a buy, right? So if you do the opposite of a sell, you're buying. And so you're helping to fuel this on the upside. And opportunists like ourselves will come in here and we'll see this opportunity and we'll come in here and buy as well. So you have the sellers who are getting out of their bad trade. And then you have the buyers like us who come in and help fuel the move to the upside, right? That's liquidity. Any questions about liquidity before we move on? I just want to make sure that this part's covered. So, and you can also come back to the recording if you want to get some more info on liquidity and learn more about it. The best kinds of liquidity breaks, by the way. So I don't want you guys just trading any liquidity that you find, because there's liquidity everywhere on every time frame, on every instrument, right? What's the best kind of liquidity to trade? So there's a couple of things that I do to find the best liquidity because I don't want you trading every single zone. So how do you kind of filter these? I do a couple of things, and that's one. Roger's got it. Like it has to be fresh liquidity. Yeah, it has to be liquidity that hasn't been tapped into yet. What does it mean for liquidity to not be tapped into yet? Basically, it has to be a zone that's never been used before. Okay, so back when this move went up, the market had not returned back to this area yet. So the first time it returns to this area, like it did here, was the best time to use this. After this got used, I probably won't use this area again. Doesn't mean it won't work. I've seen plenty of liquidity zones get used a second, a third, or fourth, fifth time, and they've worked. But the possibility, the chance of that liquidity zone working over again, it diminishes its value over time if it gets used again and again and again. So you want to be the first to identify it. How are you the first? Well, you got to identify structure breaks. So that can either be a trend line break or it can be a break in a horizontal support or resistance. Okay. Either one works. If you can get both, like we had on US 30 last week, that's the best. Okay. If you can get a horizontal break of structure in addition to a trend line break, those are like gold, absolute gold. And if those are the only trades you take, you should be a very profitable trader. If that's the only type of setup you trade in the market is a where you look for a trend break coupled with a horizontal break. Those are just some of the tremendous trades. Okay, so what else can you do to filter liquidity? Because there is a lot to trade. I like to use the scanner and the COT report on the higher time frames, like an H1 or an H4. Usually just an H1's fine. That's usually the time frame I trade on. I try to find liquidity zones that match up with what we're trading. So, for example, we took a trade this morning. We're trying to buy the New Zealand dollar franc right now. That looks like a good trade. It's been a good trade for the last couple of weeks. I believe it's going to continue to be a good trade to be a buyer on. And so we found a liquidity zone that made sense. Also, kind of an imbalance, which we're going to get to in just a moment, but um, made sense. And so we took that trade. So I use the scanner to filter the direction and which pairs I'm going to trade. That's a huge thing in itself. And then I trade stuff that has breaks of structure. And ideally, if you can get a trend line break and a horizontal break of structure, that's the best trade to be in. Okay. So that's what I do to filter because there's liquidity practically at every peak, at every bottom in the market, and you don't want to trade every single one of them. You just want to trade the ones that make the most sense. Okay, so the next thing I wanted to get into, oops, I didn't want to delete everything because I have some stuff over here I want to show you guys. So let's talk about imbalances because this is a little bit more of a technical concept. So, and this is the first time I've really taught it, but I've done my homework. I've done some research, so I'm hoping. Let's see. I had a nice little setup I was going to show you guys. Trying to find where it was. I had an outline. I think this was it right here. I've just deleted it. Okay. Let's talk about imbalances. Okay. Now that we know what liquidity is. So let's start with it. I'm just going to go in raw with this because I'm going to try and I'll go backwards if I need to, but let's start with this. What's the most interesting thing you see on this chart here? Like, what's the most interesting candle? Is that anybody want to point it out? Just say like if you see a candle on here, like what is there a candle on here that you guys like look at and you're like, holy smokes, that's a crazy candle. Yeah, yep, that's exactly what I was hoping you would say. So yep, the big green one. That's probably the most interesting candle. Yeah, right here. Right? That's the big one that's like staring you in the eye, right? That's the one everyone's looking at. And it's not just the one that you're looking at, it's the one that I'm looking at, and it's also the one that the banks are looking at, and it's the one that everyone else is looking at because everyone else has access to the same information. Okay. This is really important. Not just because it's super like viewable from the eye, but because of what it means. Okay. So an imbalance occurs when an expansion, okay, and so hear me out here. I'm going to try to make a good definition of this. An imbalance occurs when there's the pure definition is inefficiency in the market. And it's usually where there's only one person driving the market. In this case, it's only buyers. So you only have a buyer right here, and there's really no sellers. There's really no chance for a seller to get into this market because during specifically during the candle itself, why is it very hard for somebody who's a seller to get in on that candle? Because the candle occurred so quickly that it's hard for sellers to actually get in. Does that mean there aren't sellers? No, there's probably plenty of sellers who had sells in this contractionary phase, this consolidation over here. Um, but whoever came in with all the money, Mr. Moneybags came in here and created that big candle, right? When this happens, it's very hard for the market to return back to the original liquidity zone. So we've established already, we spent like 20 to 25 minutes earlier just talking about liquidity is, right? So liquidity would be like this area right here. Why is this liquidity? Because this is the base of what created this big, huge candle, right? Everything still applies, right? Like as far as you still have buyers, you still have sellers that were in this area. By the time this thing breaks out, the buyers are really happy and the sellers are not happy. But if you're a seller, and you didn't stop out, you have to figure out how to get out of this trade for the least amount of loss possible, right? That's how the big banks and other big players are thinking, like, okay, who, especially those that didn't have a stop loss, right? Like they're thinking, how the heck can I get out of this trade? Where's my exit on this option or on this trade that I took? Okay, so all of that still applies. Okay, so this big, huge thing happens and an inefficiency occurs, right? And this is still liquidity. But here's the problem. When you have such a huge candle like this, where it's not like a controlled expansion, this is just a single candle. Like this happens at news events all the time. Inefficiencies and imbalances, that's a really common place where this kind of stuff happens, which, by the way, just as a reminder, there is a Australian rate statement tonight. We've got RBA statement. So just be aware of that. I think that comes out at 11:30 p.m. Eastern. So just be aware of that beforehand. Okay, so okay, I think we got enough context here. So when you get a huge candle like this, sometimes the market isn't able, it's actually not able to go back to the liquidity zone. So we've already, well, like I said, we spent 25 minutes talking about what liquidity is. This is liquidity clearly, but the market is not able to go back to it because this is such a huge candle. Okay, and this is just one example. Some of the examples I'm going to show you in just a second are multiple candles that are just like 2 or 3 candles just like this one in a row. Okay, when this happens and it's just a clear, just solid bar, the inefficiency has to be balanced out. Is the best way I can explain it. And so sellers who were stuck down here selling, they're going to take a loss, but they're going to find a more interesting place, maybe like a support or resistance area to fill in that imbalance. Okay, so there's actually indicators you can use to, and we're gonna at the end, I'm gonna show you some different imbalance indicators you can use on TradingView, but I'm gonna show you how I have been able to find places of imbalance. So this is different than this is like a different style than like ICT or from other places where you might learn about imbalance trading. And I feel like I've got a really good edge on this. It's worked very well for me. So here's what I do. When I get a huge move like this, I obviously am not going to use this down here because I can't. I can't use this. The market's probably not going to come back down to that. I mean, it may, but it might take a long time. So where is this market going to pull back to?
Hey traders, it's Steve from the future. I hope you have enjoyed this video so far. If you are getting value out of this video, be sure to hit the like button, click the subscribe button, and share your trading thoughts. I read all the comments, so feel free to ask any questions you have there too. On a side note, I host live trading calls like this one you are watching every day. Some of my biggest trading secrets I share exclusively to just the members in my program. I host these live trading calls every day, Monday through Friday at 11 a.m. Eastern. I also host a basic training webinar every Monday for the newer traders and the regular COT report and sentiment trading webinars every Wednesday night at 8 and 9 p.m. Eastern for the advanced and aspiring traders. All of these calls are recorded and promptly posted on the members' trading calendars at the conclusion of each call in case your schedule does not permit you to come to the live call. All of my members have complete access to the scanner. We call it Steve Scanner. This is an institutional grade trade alert scanner that picks the direction of the week on all 28 major currency pairs and includes trading instruments like gold, silver, NAS 100, US 30. Just in the last 90 days, I have made over 3,000 pips just taking the top trade signals from the scanner at the beginning of the week and then just holding those trade alerts until Friday. If you want access to the scanner, you can start a 14-day free trial with the join link in the description to get started. Lastly, if you really want to be a full-fledged VIP member of my program to get access to things like the basic training course, live signals channel, Steve's scanner, trading calendars, and the one-on-one calls with me throughout the month, you can use code YouTube50, that's YouTube50, no spaces at checkout, and save $50 on your first month. Again, just click the link in the description below and apply that coupon to become a VIP member, and I look forward to helping you with your inevitable trading success going forward. Now, back to the video.
You actually can use a Fibonacci, but before I use the Fibonacci, I actually go back in time further, and I'll actually draw out the whole candle itself. So I'll actually put a little um, rectangle here, and I'll sweep this to the left. Okay, I'll just sweep it to the left, and I'm going to find where were liquidity zones in the past, okay, or support and resistance areas. So I found one right here. This is just, and it doesn't matter if it's like supply or demand liquidity. It just has to be an old liquidity zone. So right here, this was like a break of structure. You can see that this was some kind of break right here. You had like a support area over here. And so you follow this move backwards because this is an expansion right here to where this move was created. Okay, you're like, okay, whatever happened up in this uh, consolidation area, this contractionary phase, that would be old liquidity. And that would be where I would um, assume that the imbalance may get filled in, is something like right in here. Okay, so basically this area, because whatever happened in here is ultimately what created this expansion, and it happens to line up with this this big huge candle that would fill in the inefficiency. That would be an area that would work, basically, okay, for an imbalance type of trade. So if I bring this forward, you'll actually see right here the market. I think it actually hit twice. Yeah, here it is. So you'll actually see the market touch this. It filled in the imbalance. This market went up and up and up. It actually continued to go up even past this green candle, and it continued to go up. And then it started to pull back, and it pulled right to the inefficiency. And then it came a second time, actually. So if you didn't actually get it on this first time, you could have got it definitely on the second time. And it came right to this old liquidity over here. So you can't use the original. Again, we already identified that this was a liquidity zone, but when you have a huge candle like that, you can't use this typically. It's hard to use. It's very difficult. And in fact, I've placed dozens and dozens of trades in the past, just limit orders that never get filled, buy limits down in liquidity zones like that. They just never get filled. So you have to kind of compromise and work with what the market's giving you. And so this is like my secret. I think I'm the only one that teaches it this way. Like I'll actually go back, I'll still use liquidity, but the steps to doing this are you basically draw out the full candle or the full and it doesn't just have to be one candle. It can be an entire, like if you have two or three, I don't know what we call these candles. We'll just call them pillar candles, where they're full candles. They have hardly any wicks on them. They're just boom, 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 boom. Those are, you know, imbalance candles, inefficiency candles, whatever you want to call them, news event candles. And then you just draw it out to the left, and then you just go find the most logical liquidity zone from the past, right? So you just draw this left side, and you're like, okay, so this was a break of structure here. What created this expansion? Okay, it was this area right here. So basically, like, generally, this area is what created this expansion. And so that would be a likely area for this inefficiency to be filled in. And that's exactly what happened. And so what you would do is when you get back to this point, um, like when you get to like say here in the process, what you would do is you would actually place a trade, a buy limit order, right here at the beginning of the inefficiency that you identified. That makes sense with old liquidity. And then you would place your order like this: stop loss at the end of the liquidity, at the end of the inefficiency. and then you can target a 1 to 2, 1 to 3, or 1 to 4, whatever it is that you think you can get. Again, that's not what this class is about for taking profits. It's about identifying the imbalance and then where you could place your trade. And then obviously, if you fast forward, we already know what happened. This market came down, hit the inefficiency right there, and then you'd be off your on your way. And then it looks like it came down one more time, as you guys already know, came and hit it one more time, and then it was on its way. So really, really cool trade there. Let me show you another one. This is pretty cool stuff. Do you guys have any questions so far? We can come back to this chart if you want. In fact, I'll just stay here for a second. Let me read some of these questions, and then if you guys have other questions, we'll do that. I do have 2 or 3 other examples I want to show you before we wrap up today. Lee says, with that big candle, would it be helpful to drill down to understand exactly how much of the let's see, let me read this. With that big candle, would be helpful to drill down to understand exactly how much of the hour expansion lasted. I know it went straight up, but it was early or late in the hour, or was it stay? Oh, I see what you're saying. Yeah, so yeah, I don't know if it is. But I think it's worth the study. I think it'd be worth looking into. Um, because yeah, that's hard to tell. The only way you would be able to tell if it was early or late in the hour is if you change time frames. So you'd have to go down to like a 15-minute chart and see, because this is an hourly time frame and that whole thing happened in an hour. So you could find out if it happened in like the first 15 minutes, or was it a steady thing over four candles, which equates to a 1 hour candle. That's one way you could figure it out. But I don't know if it does. I haven't really looked into that too much. Um, um, just because I almost exclusively trade on the hourly time frame. And so I mean, sometimes I'll jump down to a 15-minute, but my guess is that the 15-minute candles would probably be, it'd probably tell you about the same thing too. But I don't know if it would be any different. And it doesn't negate the fact that this is still old liquidity right here. And this is the area where the likely inefficiency is going to get filled in, is right in here. So, but yeah, that's a great observation. All right, let's keep going. Let me show you another couple examples I've got one right here. So, yeah, let me show you this. So, this was a huge candle. Let me delete all this stuff. Let's look at this. So, this was very recent. This is on the hourly chart with the pound yen. Um, so this was a huge candle. And it does have a pretty big wick at the end. That's not necessarily a deal breaker for an inefficiency, because it's still an inefficiency nonetheless, okay? Because it's a huge candle. So the idea here is, again, if it's a gradual impulsive move that has lots of successive candles that follow it, um, you can almost always just use the liquidity zone itself, and this would be the liquidity zone, because this is exactly where the traders were buying and selling, everything was going great, and then boom, right? So what happens is, at these news events, the inefficiency happens and you can't use liquidity. So you have to find another place to put your trade, right? So that's where the imbalance style of trading comes into play. So you can't use this liquidity zone. So you have to find something else. So what else can you use? Um, so this actually had a nice like spot right here. This is not the most obvious place, but I'm going to help you guys see what's going on here. So first of all, remember what you do. If once you have that huge candle, let's do a rewind here so you guys can see what I'm talking about. So let's do a rewind. Here's the new big candle. So let's say you just get this huge candle and this is what the market's looking like. And you're thinking, okay, great. So we got breaks of structure. We're clearly breaking to the downside. I want to sell with this move. I want to start making money with the sell, but where do I get in? How do I get into this trade? Okay, so what I would do is first do what I told you to do in the last one. Draw a just a rectangle here, or box that you can draw backwards. And then you're going to try to find areas of liquidity, and try to find where the market has formed liquidity zones in the past that have broken structure. So this actually did, like, right in here. whatever happened in this general area ultimately led to this market actually breaking up for the next several days before it had that big move to the downside. So let me delete this real quick. So you can kind of see if you draw this out, like there was a horizontal resistance right here. We broke structure right there. And so what created that move? It's whatever took place inside of, like, basically inside of there is the um like whatever happened inside of this is what ultimately created that extensive move that lasted for so many days until, and then the volume slowed down before the news event, obviously. Okay, and then it just dropped like crazy. But this would be it right here. Like this is it. So now if you draw this over, this would be your sweet spot. That would be where you fill in the imbalance, is right there. Okay, so now if you fast forward, like if you were to place a trade there, like this is what it would look like. You'd place a short starting at the imbalance. You might actually be able to start it a little higher. You don't have to necessarily use the wick, but I'm going to use that wick right there, nonetheless. And then your stop loss would go like right there. Okay. And then you could work out your trade like a 1 to 2, 1 to 3, however you decide to do that. Um, and then you would just fire off. Okay. Then you let the trade go. Boom. Perfect. So literally goes up to the imbalance area, fills in the inefficiency, the same area that created this break of structure right here. And so this is how you compromise with a big fat candle. Okay, big fat candle. Um, because this is the ultimate area. We just established that this is liquidity. Like liquidity is actually up here, but that only works if you have an efficient move. This is not efficient. Okay, that's only sellers. That's only banks. So when you get that, you have to work with something else. Let me show you another one. Unless you guys have other questions on that one, we can come back to it. Here's another one right here. This one is a little easier to understand, I feel like, but it's the same concept. So this is a huge candle, right? Like no doubting that for sure. It's like when you look at this, what's the most interesting candle you see? And I think most of us would say, yep, that's the most interesting candle right there for sure. So now what we do is we say, okay, this is the normal liquidity I'd like to use. I'd like to use this area to sell at, but I'm probably not going to get it. Like that's a huge move. So there's going to be an inefficiency here. Why is there an inefficiency? Um, there's an inefficiency because um, when that candle was formed, it was just basically sellers in control. And there's buyers who are stuck up here. So they have to compromise and find their place to get out. Where are they likely to do that? Well, they're going to get out probably at the next, like they're going to fill in that inefficiency, and they're likely to do it at a previous level of liquidity that's not associated with this area. So how do you find that? Again, you draw this out, draw this candle out, you draw this sideways, and then you go hunting for a major liquidity zone that created a break of structure. So what I see here is this. So I actually see two different places that look pretty good. Um, I see um this candle right here, whatever happened inside of here broke structure, and also whatever happened like right there. Because whatever happened in those two areas ultimately broke this market structure to the upside, and that's what sent it up from there. Let me see if I can figure out any. No, that's about it. So that's all I've got to use right there. So this would be the inefficiency area right here. That would be it specifically. And that's what I could use right there for the imbalance. And that's where the trade would go. So now we bring this forward, and you can see exactly that's where the market came up to. So you can see right here the market pulled down. When it came back up, it came right to this area, and then it started to pull back again. It actually came up twice. It came up here once, pulled back, came up second time, pulled back. It didn't continue on. Like it actually found liquidity. It actually did come up and find this liquidity later on. Like we actually did tap into this old liquidity zone later, right through here. Oh, and here too. but initially that's not what was available. The market did not respect that zone initially because it used let's expand this out so you guys can see it. It used this area over here, and that's what the market liked when it came up to this, and that's when it pulled back. So that's how you can find reversals in a market that has an inefficient candle. Um, okay. So I usually, like, again, when I use this, I have to find, pretty aggressive moves. Like, I'm not just going to use just any imbalance. And again, I use this, how do you get confirmation with imbalances? So I will try to find currency pairs that match up with their scanner. If the COT data indicates that there's, a lot of buying activity by the banks, and I can see that the scanner shows that and indicates that there's a lot of buying going on, then we're going to be looking for buys. And then if I can find an imbalance zone, then I'll place my trade on that imbalance. Um, Same thing with the sell. If I see that the banks are selling, that's how I'm going to filter a lot of trades. And then the other thing that and then breaks the structure, obviously. So, like in this example, you're looking for sells initially because that's what happened, right? When this thing broke, what are you doing? You're looking for sells because that's the way we're going. We're breaking structures. We broke this structure to the downside right here. That's where we had a break. And so now we're looking for sells, but that's the thing. I can't sell right here at the normal liquidity zone. I can't use that because the market broke down so aggressively, it formed an imbalance candle, which is this right here. And so you have to go back and find an alternate place to place your trade. And this is how you would do it. And so now, if you fast forward, um, the market will eventually try to go fill that imbalance, and that's where your sell trade goes. And then you go from there. So, um, but I don't know what the COT report said on this. I'm just trying to show you an example. So those are the examples I found that looked pretty good. If you guys find other ones, then you can do that. Oh, which by the way, I wanted to uh, have you guys do this. So as a homework assignment, I wanted to invite each one of you. Now that you've seen this, feel free to come back and review this call because it is recorded. You can go back and see those specific examples and pause it because sometimes I go quickly and you're all learning this concept. So if you want to go back and pause, feel free to do that on the calendar. And then I want to invite each one of you to send me on Telegram your imbalance opportunities. If you find a setup, feel free to text me or send me Telegram's nice because you can just take a picture of the trade, a screenshot, and just send it over, and then I can review it. Usually just right at my computer. That's a really nice thing to do. And then I can kind of critique it or just tell you it looks good type of thing. Maybe find one or two of those this week and send them to me. I'd love to help you guys out. If you find more, fantastic. You don't have to do it, but it is a homework assignment that I think would really help each one of you in your progress to being a successful trader. So, all right, guys. Well, I don't have anything else. Any other questions? I think that's a good timing. So, okay, I don't see any questions. I'm going to go ahead and wrap up. Appreciate each one of you. Have a fantastic rest of your day, and we'll see you guys in the next webinar. Thanks for coming.